Good morning and welcome to the third in this series of Global Equity Investing Through Managed Account webinars. It's been a pleasure for us at IMAP to bring these webinars to you. And I think it's been really interesting for us to have a series of webinars on a single topic. It's enabled us to approach a single topic in more depth than an individual webinar would have enabled us. Before I hand over to Nathan Lim of Morgan Stanley, our moderator for today, I wanted to say a little about today's presenters. Nathan will introduce the presenters themselves, but I want to say a little about what it seems to me they represent in terms of the developments of managed accounts. It's a particular pleasure for me to have Hyperion presenting at an IMAP webinar for the first time, because Hyperion was the very first investment manager that in 2004 I had the good fortune to work with. And it seems to me that the Hyperion team, which Mark Arnold has been part of since then, represents one of the evidences of the way in which managed accounts have now started to develop a really durable track record as a way of delivering investment outcomes for clients. Another of our presenters today, Swell, are interesting in the sense that they are a pure managed account investment manager. Who would have thought that investment managers would have said, this is the path we're going down? And finally, Nanuk, it seems to me, in their focus on sustainable business practice as a driver and a guide to investment decision making, is representative of the way in which broader investment considerations are coming into managed account portfolios. So it seems to me that we really have in today's presenters some really interesting insights into the way in which managed accounts have developed and will continue to develop as a core part of the delivery of advice services. It's now my pleasure to hand over to Nathan Lim. Nathan is the head of wealth management research at Morgan Stanley. Morgan Stanley this year were the winner of the IMAP Licensee Managed Account Award. And as it happens, Swell were also a finalist in the IMAP Managed Account Awards in the Australian Equities category. So Nathan, thanks very much for moderating today. Over to you.
Thanks, Toby, and hi everybody. Welcome to today's session. As Toby mentioned, we're going to be talking about international investing. This time, we've actually got through three very high caliber fund managers. Let me introduce each of them in turn. First of all, we've got Lachlan Hughes from Swell Asset Management. So Lachlan founded Swell back in 2014. He is their CEO and CIO and also runs the Swell Global Portfolio. I met Lachlan when he was a senior analyst at Novaport Capital. That was the old Challenger Small Companies Fund, when over a 5-year period, that team did a 24% CAGR versus the Small Ords, which was only up 15. Lachlan is a former corporate lawyer and a CFA charter holder, so really don't argue with him about points of law or with investing. And just as a final point on Lachlan, yes, as Toby mentioned, he was also a finalist in the International Equities category for the 2020 IMAP Award. Next, we're going to have speaking today is Mark Arnold from Hyperion. Mark's the CIO and the managing director at Hyperion. He is their most senior portfolio manager. Mark's been doing this professionally since 1991. He also is a CA and a CFA charter holder. And I'm just going to talk my book here for a moment, but you guys should know that the Hyperion Australian Growth Company Strategy, this is actually on Morgan Stanley's focus list. Now, for those of you who don't know what the focus list is, that is the one manager that we use in a specific asset class across all our model portfolios for all our clients. So when we go to look for off the shelf, which is the small cap Australian manager that we prefer, it is Hyperion. And lastly, who we've got speaking today is we've got Tom King from Nanuk Asset Management. Tom is Nanuk's CIO and a PM. He also has a very diverse industry experience within equities funds management, investment banking, and private equity investing. Like his fellow panelists, he is multi-skilled with a degree in engineering from the University of Melbourne. He's also an Olympic gold medal, by the way, in sailing, and he has an AO for services to sport. Now, I had the pleasure to meet Tom when I was back at Australian Ethical, and I can say that their approach, Nanuk's approach to responsible investing, and this is just my personal opinion, their approach has absolute integrity and is true to label. So with that, I'm going to pass it over now to our three speakers. We're going to let each of them sort of give us a few minutes on what I like to describe as where they're shopping and why they're shopping there. So we're going to start off first with Lachlan. So Lachlan, go ahead.
Thank you, Nathan. So where are we shopping and why? Well, we find all of our opportunities at the company level, and we're effectively looking for two things. We're looking for a time arbitrage, and we're also looking for hidden value. And basically the time arbitrage is just a fancy way of saying we'll invest for the long term. And we do this because as the investment horizon lengthens, the market efficiency decreases. And that's true of large caps as well as small caps. And the second thing we're looking for is hidden value. So this is trying to identify companies that are under-earning. And now companies can under-earn for a variety of reasons. They may be under-earning because they're about to release a new product, they may be about to enter a new market, or they may have some technology that's yet to be commercialized. And we see both of these things at the moment in the Walt Disney Company. And I think the time arbitrage is a fairly easy one to see here because the theme parks are obviously impacted by COVID, and the cruise ships are also impacted by COVID. And the hidden value here is that they're moving from a third-party distribution model that's distributing their content to cable operators like Foxtel and others around the world. And they're moving to a direct-to-consumer offering. And this is a very important shift because they're going to get a lot of access to data. And this means that Disney will be able to see what people are watching, and they'll be able to see where they're watching it from location data, and even how they watch it, which opens up a bunch of revenue opportunities, discounts on the theme parks or special offers for cruise ships and merchandise opportunities. And this is a very big market. So the opportunity here is about 750 million homes globally, excluding China, all with access to broadband. And the Disney brand travels. It's a very well-known brand all around the world. So, Nathan, we like this one. We think that Disney could acquire hundreds of millions of subscribers with this new distribution model, and it's one we're very excited about.
Yeah, that's great, Lachlan. I think it's true that some of the best businesses right now are the ones that are actually turning back on themselves and really mining that data. That's something that we've seen for the last decade, and it's good to see that Disney has jumped on that as well. So with that, let's pass over now to Mark from Hyperion.
Good morning, good afternoon, everyone. In terms of where we're shopping, that's really a function of what we see the environment like. We think it's a highly disrupted world that we're facing with low levels of economic growth. And so we think it's going to be a very harsh environment. Only the strong will do well. We think that many businesses will have zero value over the next 10 years. So we're focused on investing in modern businesses with an ability to grow market share. And we think that this is really important in this low growth environment because traditional growth from sharing in the growth of the overall economy is going to be very limited in the future for most businesses. We invest in innovative businesses with strong value propositions and large addressable markets. We invest in disruptive businesses that can take market share from old world businesses. We avoid most listed stocks because we believe they are old world, mature and likely to be disrupted. We're primarily focused on developed markets because we think that they offer better risk-adjusted returns. We think you go up the risk curve pretty substantially when you enter emerging markets.
All right, Mark, thanks for that. And actually, there's a very interesting point there where you're talking about what I like to call basically winner-take-all approach to investing. And actually, it brings a very interesting question up about regulation and monopolies. So we're going to touch on that on the third question today when we talk about ESG. But before that, let's just go to Tom. Tom, tell us a bit about Nanuk. Tom, you're going to unmute yourself there, sir.
Thank you. Thanks, Nathan. So where do we invest and why? We invest in areas related to environmental sustainability and resource efficiency. And we've chosen to focus on those parts of the broader market because we think they're likely to be an enduring source of attractive investment opportunities. And they involve a level of complexity and inefficiency that suits itself to active management. In a broad sense, we believe that environmental issues and resource constraints necessitate some very significant changes in the global economy over coming decades, because you just can't reconcile continued population and economic growth and rising consumption with very evident issues today, including climate change, but not limited to climate change. And one way or another, things are going to change around the world, and there are a set of industries that are likely to benefit from those trends. Now, within that, maybe if we can flick forward in the slides, there are some fairly obvious structural changes that are already underway. We've seen some pretty profound changes over the last decade in areas like renewable energy and more recently electric vehicles. But if you look at the scope of changes that are required in coming decades to align with some of the environmental objectives that are being set out today, there's a much broader set of industries that are areas of focus for us. And the challenge for us and where we're looking today is being dictated by the way that markets are pricing assets differently. And we've seen some extraordinary performance in areas like electric vehicles and renewable energy recently that have led us to focus in other areas where we think there are very good prospects of accelerating growth in areas like building energy efficiency and sustainable materials and packaging.
Thanks, Tom. I think clearly if there was one argument for active management, that's clearly around sustainability, because there is no passive way to deal with climate change. So I think this is just that your type of investing just naturally lends itself to having an active manager, because you're right, it is extremely complex with the issues that we as a world have to collectively deal with. So with that sort of introduction, I'm going to bring everybody around to sort of like our sort of questions that we're going to talk to today. What I'm going to do is I'm going to ask each presenter to address a specific issue. And the first one we're going to talk about, of course, is that we're just literally days away from the US elections. So Lachlan, why don't we start with you first? How are you guys positioned for the risk event that is coming? What are you thinking are sort of the key risks going in or coming out of that?
Yeah, absolutely, Nathan. So I guess at Swell, we're trying to focus on two things: the important and the knowable. And while we think the outcome of the election is uncertain, while we think it's important to know what the outcome is going to be, but we don't think it's knowable. And in that situation, it doesn't make sense to build a portfolio around an uncertain event. And if we look at our portfolio, the things that will drive our companies will be specific factors. So if it's selling more tractors for John Deere, or it's Apple selling more iPhones. But in terms of the regulatory environment, it's one we're watching closely, because we do own big tech, and antitrust is clearly something that's top of mind for everyone. Look, I sat through a lot of the testimony and the hearings. The one thing I took away was that the Democrats are taking a slightly harder line on big tech than the Republicans, and they seem to be very much focused on market power. The Republicans seem more focused on content moderation, conservative content moderation. But I think the challenge for both the Democrats and the Republicans, whoever wins this election, is going to be regulating these demand-based monopolies. And you can really contrast these to the supply-based monopolies of yesteryear. So if you look at Standard Oil controlled the supply of oil. AT&T had the only wire that went to your house. They controlled telephone services. And you can really contrast that supply-based monopoly with today's demand-based monopolies. And how do you create a demand-based monopoly? Well, you provide a fantastic user experience. So, people who use Apple like using Apple. People who like using Google use it because they enjoy what Google does for them. So I think it's going to be very hard for either party to regulate these businesses. But look, if we are wrong and they do get broken up, we still think that they're worth more in a breakup scenario. But fortunately, there's remedies available. And I think we're going to see maybe a broadening of the consumer welfare standard. I think that there'll be specific rules around the App Store for Apple or with Amazon and their third-party sellers. But look, I think they're manageable under either situation, but it's certainly from a regulatory perspective, something we're thinking hard about.
Yeah, that's great, Lachlan. But Mark, from your perspective, you guys have got more of an Australian tilt. Do you think that the read-through of the U.S. elections, and as Lachlan pointed out, around technology regulation, is that something you guys are thinking about? How, or more importantly, how are you guys thinking about it?
Yeah, we have been thinking about that, and that's one of the reasons why our weightings in of Facebook and Alphabet have come down in recent years, because we think that there is an increasing probability of regulation. It's difficult to know how it's going to play out, but if the businesses are those businesses are broken up by the regulators, we do think there's a reasonable chance that it's going to be value enhancing, because we think the sum of the parts will be worth more than the whole for some of those businesses, because we think there's some hidden value in things like Instagram for Facebook, etc. So yeah, so that'd be our view. We think the Democrats would be good for renewable energy stocks. So we have Tesla in the portfolio, so they're sort of at the core of that. So we think if the Democrats can, get
yeah, Mark, that's actually a great point there. That it's pretty clear that under Biden, he's taken very much more of a sort of progressive approach on the environment. Trump is very much let's save coal. So Tom, I guess this is naturally leads into you. Nanuk being very much focused on a sustainable future. What is your view on the outcome of the elections?
Look, similar to Lachlan, we don't see ourselves as being in the business of betting on that kind of outcome. If you look at the odds, they're certainly favouring Biden winning convincingly, and probably the Democrats getting control of the Senate, which is going to be very significant from an environmental regulation perspective, not just within the US, but it'll have flow-on effects globally, and that's something that for our strategy is likely to be a good thing over the medium to longer term. A lot of that sort of expectation is already well priced into things like the solar stocks and to some degree some of the EV stocks. But if you look at Biden's policy platform, he's talking about embracing a 2050 net zero carbon emission target, 100% renewable energy target by 2035, and energy efficiency standards across the country, all of which will have very significant effects if they're embraced. And in the short term, he's talked about a $2 trillion program of stimulus expenditure directed towards sustainable and clean technology, things like electric vehicle manufacturing and EV charging infrastructure, renewable energy, and so on. And clearly, if they can legislate that through Congress, that's going to have a big effect. We have to wait to see what the outcome is. It's not a certainty that it all gets passed in that form, but potentially very positive. Interestingly, on the flip side, I don't actually see Trump continuing as president as being particularly negative for the areas we focus on. The reality is that the states themselves actually control most of the environmental policy agenda in the US anyway. So California recently announced a ban on gasoline car sales starting in 2035, which is clearly hugely positive for the likes of Tesla. And that kind of progress has been going on for 4 years and will probably continue even with Trump in place. But I mean,
all right, Tom. So I guess it's pretty clear that it's, as you guys are pointing out, it can kind of break either way. But I get everyone's so focused right now in the U.S. There's also the other side of that coin, which literally on the other side of the Pacific is China. China is going to be the biggest economy in the world within 10 years. Mark, how are you guys dealing with China's rise, or not?
Well, we think that you're going up the risk curve if you go into China directly. And our view is that effectively China is turning Japanese. We think that they've got an aging population problem. They've got very low population growth. There's been a gearing up of their society. So debt to GDP is up at 274%. It's doubled over the last decade. We think there's been poor allocation of economic resources via really large government spending programs that are less and less effective as they go through time. There's high levels of corruption and increasing levels of corruption, no rule of law, limited IP protection. So all of these factors we think are going to impede future growth rates. So we would question whether China will ultimately become the biggest economy in the world. We just think it's really difficult to invest in China. You've got a one-party state as well. So we think that, that has lower growth for China has negative implications for commodity prices. We think the super cycle's over. And so we think that will impede commodity price growth and also inflation going forward.
Fair enough. And Lachlan, your perspective on China, do you think that it's all doom and gloom, that they are facing a demographic wave they can't deal with, or do you think there's another way of looking at it?
I think there's another way of looking at it. We classify China as a wonderful opportunity. It's, as you said, Nathan, it's the world's second largest economy. It's set to be the world's largest economy in the next 5 years. And I think it's very, very hard to bet against 1.4 billion people who are working hard every day to make their life better. And if you think longer term, I mean, if you look at the GDP per capita of the US, I can certainly see a situation in the next 15 years that China's GDP on a per capita basis will get to 1/3 of the US. 1/3 of the US. It doesn't sound too challenging, does it? And at that point, the economy would be 40% larger than the US economy is today. And we like what's happening in China at the moment. You look at the next 5-year plan. They're promoting consumer spending, they're promoting technology development, they've got a rising middle class, they're building out digital infrastructure, they're focused on high growth areas like chips, AI, IoT, 5G. And look, the way we get around the regulatory issues is we invest in Chinese businesses. I mean, Tencent and Alibaba are Chinese businesses. They're predominantly in China. They have small operations outside of China, but they're principally domestic Chinese businesses. And I think the government in China has a very different relationship with these companies than the US has. And we saw this through the COVID period. So the Chinese government used Tencent and Alibaba to help stimulate the economy. They distributed vouchers, food vouchers to people via these apps. So look, we feel very good about China. And I think the one thing you got to remember is these are the two largest companies in the world, and they rely heavily on each other. And the global supply chain is integrated, and it's very hard to decouple. So I think fundamentally, given the fact that they both rely on each other, self-interest will win in the end. And we feel very good about our investments in China and very good about China.
Very good. And Tom, I think you probably know this as well as anyone. People always forget that China's investment into renewables is second to none. But beyond renewables and where they are now, do you think there's another angle to China and energy, or is there something else we should be thinking about?
I think if you look more broadly at the sustainability issues in China, they have a lot of environmental problems, having developed their economy so quickly in the way that they have, and they have, expressed and shown a pretty serious commitment to fixing some of those problems over time. They just announced their 2060 carbon neutrality plans, and if they're to go even remotely close to achieving those kind of objectives, the implications are really way beyond just renewable energy. You're talking about the entire transport sector and huge parts of industry that need to change. And we see opportunities in all those areas. Many of them are difficult and challenging to access as a foreign investor, and come with risks that are higher. And so we have relatively limited exposure within the fund today, but we see China as a major player in many of the global sustainable technology supply chains. It's a strategic sort of imperative that they're pursuing in a way that's much more aggressive than what we see elsewhere in the world.
So while we got you the next question is really around ESG, or environmental, social, and governance. What are the trends that you guys are seeing?
But there's a lot going on there. There's a lot more talk about ESG today than there was a few years ago, and that the nature of that conversation is changing quite quickly and maturing. ESG integration is obviously something that's increasingly widespread. UN PRI membership's growing, and most major managers are either signatories or doing the things that membership involves. ESG products have performed well over recent decades. If you look into that, that's largely to do with low exposure to traditional energy, oil and gas, and a bias towards high ESG rating companies in areas like tech and healthcare. But that performance is sort of supporting the concept of ESG in the short term. We're seeing increasing focus on stewardship expectations of managers. And that's not an unreasonable expectation. I don't think that it's something that's going to go away, and it's tied to an increase in sort of regulation around ESG disclosure requirements and the like, particularly in Europe. But I think that the big trend for investors now is you're seeing a delineation between different types of responsible investment, between traditional ESG approaches that were largely or are largely centered around understanding ESG risks and managing those within portfolios, and other areas like ethical investment and activist and engagement investment and sustainably themed and impact investment. And the distinction between those strategies which are focused on investing in better companies, which is a perfectly valid approach, from an ESG perspective, investing in companies with characteristics that conform more closely to best practice, and differentiating between that and investing in companies that are doing things that are going to make for a better, more sustainable planet is becoming clearer. And there's an increasing array of data that's able to help people understand the nature of different ESG products and what they're delivering to
sort of focus on their outcomes. And Mark, a question for you on ESG. What are you guys seeing in terms of that from your clients or from your perspective?
Well, we're long-term business owners, and average holding period is 10 years. So sustainability has always been core to us. We're not just renters of stocks or anything like that. We're not day traders. So we think if you're taking a long-term view, sustainability has always been really important. There has to be something in it for everyone, all of the stakeholders, not just the customers. And that goes wider to the community and ultimately the environment as well. So it's really core to how we think about investing. And businesses traditionally have been able to externalize costs, but we think society will eventually force them to internalize those costs. So we take that into account when we're looking longer term at our investments. We've got a really low carbon footprint for our global fund. It's about 13% of the index. And Hyperion itself has basically wiped out our carbon footprint since 1996. We've bought sufficient carbon credits to wipe that out. We think it's an important issue, and we think that the disruption that's coming down the pipe as a result of carbon emissions is likely to be more significant to the global economy than what COVID-19's been.
Yeah, I like to say to people, you got to eat your own cooking. If you believe it, then you got to live it, right? I meant to actually ask you a question from earlier around monopoly regulation, but maybe I'm going to toss that over to Lachlan. Clearly, you guys are looking at technology. Clearly, the regulation is changing. What is the risk that you have a winner take all, and all of a sudden you are sort of broken? There is that breakup risk. How are you guys thinking about that, Lachlan?
Well, as I said before, I think that if these businesses are broken up, they're worth more in their individual parts. So a breakup is not it's not anything we want for the long term, but I guess for the short term, a breakup would be positive. When you look through the arguments on both sides, I think there's a lot of remedies available which don't involve a breakup. And I think I touched on before, regulating perhaps the data that Amazon's third-party sellers get access to. One of the issues has been that for the third-party sellers selling on Amazon's platform, they've been competing with Amazon. Amazon has their own private label products that compete with the third-party sellers, and they're using the third-party sellers' data to kind of potentially get an edge on the sellers, on the third-party sellers. So I think there's ways around it. I think, whether they have to share that data with third-party sellers or whether no one gets access to it. And then on the, for Apple and Apple's App Store and the percentage they take, I think that may be regulated, but I think the remedies are there. And truly, when you look globally, China is very supportive of its largest tech companies. And these tech companies are the bastions of innovation. And I always think for the US, do you really want to break up your bastions of innovation? You look at the top 10 technology companies, half of them are Chinese. So I think, look, there's a Cold War in technology, and I just don't think in the US's best interest to break these companies up.
Yeah, fair point. I'm actually looking at the next two questions here, and they were related to stock picking methodology and how you manage risk. And I know as a former PM that the two go hand in hand. So maybe if I can just ask each of you to sort of take those two questions together. How does your investment methodology tie into risk management? Mark, why don't we go with you first? How do you guys think about that at Hyperion?
Well, we're trying to invest in really high quality structural growth businesses. So we think that high quality businesses have lower fundamental risk. So we think the underlying risk in our portfolios is quite low as a result of that approach that we take. These businesses are really robust. They're not sensitive to economic conditions. So, and we think that, as I was saying before, in a low growth world, a disrupted world, you're going to have to be really selective. Just buying a whole lot of average quality businesses isn't going to get great returns, we don't think, going forward because of that low growth. Most listed businesses don't have the ability to take market share. And those businesses are sitting ducks for disruption. So we think that, that's in that sort of environment, you've got to be selective. So we're really super focused on those high quality, more robust type businesses to reduce risk. And then we overlay that with a long-term valuation construct as well. So return is obviously important over long periods of time. So we have to look at the intrinsic value in 10 years' time and compare that to the share price to get a return profile and then adjust for risk.
Right. So quality kind of takes care of the risk element, but then you've got to overlay that. Well, you still got to make money doing it. And so, Tom, how do you guys think about that?
Well, not that differently, Nathan. I mean, we have an approach that's valuation based. We're trying to generate good returns by buying stocks that are likely to have a perceived economic value in the future that's higher than the share price today. Our approach ends up being centered around what we describe as good quality businesses that are able to generate increasing economic value through improving their returns or growing at good rates of incremental return on capital, that are well managed in the interests of minority shareholders like ourselves, and that are likely to benefit from the way in which the industries they sit in are evolving, not just the fact that those industries are growing, but the way in which the sort of industry dynamics are changing over time. And where we can find businesses like that, we obviously look to buy them at prices from which we can generate good expected returns. From a risk management perspective, obviously our focus is on generating returns from picking stocks. Our primary risk is getting that wrong. The focus is, in the first instance, around doing good research at a company level and an industry level to inform those decisions. And then on top of that, as Mark alluded to in his process, we overlay a risk framework that seeks to avoid having concentrations of risk in areas that are undesirable and avoidable. And to the extent that those appear, we'll look to mitigate those.
Perfect. And Lachlan, you kind of touched on this topic already at the very beginning. Perhaps I can just get a little bit more granular in the way you answered this question. When we look at risk specifically, like for example, we just went through that huge sell-off in March. How did you guys react or get ahead of that during the last 12 months?
Absolutely, Nathan. I guess where we take a lot of comfort is from stress testing our models. So, we'll look at, through COVID, it was a perfect example. In March and April, we stress tested all of our models and had a look at, okay, what does it mean what happens if revenue drops by 20%? What happens if revenue drops by 30%? And we took a lot of comfort out of the fact that, our companies were, irrespective of what happened to the revenue, were able to sustain and weather any economic slowdown. And the other thing is, we always, when we acquire businesses, we only want to acquire businesses that are conservatively financed or have no debt. The majority of our companies have no debt at all. So we know that, when tough times happen, as they do from time to time, and look, you never see these things happening. No one saw COVID coming. But the way we think about it is, whenever we acquire a business, we're always thinking about the economic moat. And that for us is the key focus. The moat goes to the heart of the quality of a business, and it's really the only thing that protects us from competition over time. And we think what's even more important than the width of the moat is the direction of the moat. And I think the poster child for this philosophy was Nokia in 2007. Nokia in 2007 had 53% market share in the smartphone market. Its nearest competitor, BlackBerry, had 10% market share. And as we all know, the iPhone came out on the 28th of June 2007. And I don't think if you looked at the iPhone at that point in time, you didn't have to see where it was going to be in 10 years. But I think anyone looking at the iPhone next to a Nokia phone would have thought, maybe Nokia's moat is starting to shrink here. So we really hyper-focused on the direction of the moat. And we see that, where we have a moat that's widening, and we believe in Disney, the shift from distributing their content through a third party to distributing direct to the consumer is widening the moat. And that's our main focus. We have to, we spend a lot of time looking at the moat, but not what it looks like this year. I think everyone can see what the moat looks like in 2020. We want to understand exactly what it looks like in 5 years' time, in 10 years' time. And that is how we think about, that's how we identify stocks and how we invest.
Yeah, fair enough. I think taking that long-term view is very important. And so look, before we go to the open question Q&A, I got one last question for the three of you. We're in a low rate environment right now. How is that impacting your investment approach? Perhaps Tom, we'll go with you first. What are you guys dealing with the practicalities of low rates?
I mean, in a practical sense, it doesn't change what we do, but clearly it's had an impact on the valuation of stocks offering higher growth or lower risk profiles, anything with certainty of growth. And that's presented some interesting sort of dynamics in terms of the valuation disparity between some of the sector leaders and other businesses within those areas. And so it's a challenge in terms of looking at areas like utilities within our investment universe at the moment. It's caused us to go looking for better return potential in other sectors or in other parts of different industries we're looking at.
Yeah, fair enough. Mark, what are you doing about low rates?
Yeah, no real impact on our approach. So we're really, we've always invested in businesses that can grow in all economic conditions. So I think low interest rates are effectively saying we've entered a world of low growth and low inflation. And that really has implications for overall equity market returns. So we think that the equity market returns generally will be quite poor over the next 10 years. So in a low growth, disrupted world, you really need a bunch of businesses in your portfolio that can take market share, because that's the only growth that's going to be available. Yeah. So you got to be highly selective, and the days of just buying an index and expecting high returns are gone.
Fair enough. And Lachlan, how are you guys dealing with the low rates?
Oh, look, I agree with both the guys here. So look, you can't rely on the macro to do the heavy lifting now, and you're going to have to identify companies that are growing. I mean, most of our companies are exposed to structural tailwinds. And I think that's where the focus has to be. Low interest rates obviously has implications for valuations, and we've seen the market move up. And you often read in the newspaper people, questioning the multiple of the market. And well, my thoughts on that is, look, the multiple of the market should go up because the 10-year bond rate is now less than 1%. So look, I think it has implications for valuation, and I think you've got to be very selective about the types of companies you're owning. And I agree with Mark, it's not the time to own ETFs.
Yeah, fair point. Look, that's the end of our sort of prepared questions. I'm just going to go to so we've got some questions coming through from the audience. And again, I just remind everybody, please send through your questions. Just type them in. We'll try and get through as many of these as we can. The first one here is, no one has talked about Europe. What are the opportunities for managers there? I don't know what you guys, the three of you, are doing on a day-to-day basis. Does one of you want to offer up a view on Europe or why you're not looking at Europe?
I'm happy to comment briefly. We're actually overweight Europe compared to sort of traditional global equity indices, and we have been for some time, which at a high level might be considered to be a headwind. But when you look at the areas that we're investing in, a lot of technology comes out of the US, a lot of manufacturing happens in China, and now deployment, but really environmental policy has been led in Europe, and that continues today with their European Green Deal. And there's a huge amount of stimulus to go into that economy, explicitly directed towards areas that we're interested in. And there are many sort of multinational businesses based there that provide us with opportunities to get exposure to some of those trends. So we see opportunities in Europe. Yeah,
I would agree with you there that if you're definitely with a sustainability lens, Europe is kind of the first place, because they do seem to have the greatest focus from a regulatory perspective as well. Mark, did you have anything else you want to throw in there on Europe?
We've got exposure through ultra luxury in Europe, so we've got things like LVMH and Kering, Hermes in the portfolio. We think it's in the luxury sector, it's really a winner takes all as well. So Powerlord's sort of distribution situation where the ultra luxury global brands are really taking share from all the rest of the luxury names. So that's how we're positioned, and that's really our main exposure to Europe.
I got a next question. Thanks, Mark. I'm just going to go to the next question. It's an interesting one here. Given the very low interest rate environments are likely to persist, has the what is the right level of debt for a company? In Lachlan, I think you spoke about that earlier, about what was the right level of debt. You said 0. Do you think that this attendee's got a point that if money is free, maybe we should allow more debt?
Yeah, look, I think it's always a balancing act. But like, if my personal preference is a company is in a net cash position, that for me is the perfect situation, because if tough times hit, they can allocate more capital. Look, debt's cheap, yes, and I think it really depends on the company. Some companies can handle a lot of debt, whether they're healthcare companies, infrastructure companies, they can handle debt load. But I think it really comes down to the specifics of the business and their economics as well.
Fair enough. There's a great question here. I think this is somebody from your team, Mark, that's sending this through. What are some of the factors to consider when looking for companies long term in terms of growth or disruption? So I think that's naturally going to you.
It's really strong value propositions that are sustainable. You need a sustainable competitive advantage as well. And it's really a large addressable market. So it's pointless buying a high quality business if they don't have long-term growth potential, we think. So we're really looking for those businesses that have got fairly small market share that can grow that market share using that strong value proposition. And it helps if the competitors aren't that good. that makes it a bit easier for the businesses. And also innovation's extremely important, because you can have a competitive advantage, but if you don't innovate and improve your product set and move into other products over time, it makes it more difficult and less likely that the business is going to be able to grow at double-digit rates over long periods of time.
Thanks, Mark. Got a great question here. This is naturally going to go to Tom. How easy is it to engage with companies on ESG matters on a global level? Is it harder or easier here in Australia?
It's a difficult one for me to answer because we don't invest in Australia, and so I don't have an easy comparison. It's certainly not difficult to engage with companies overseas, particularly in the US and Europe, where disclosure requirements are heavy already, and expectations around engagement on those kind of issues is is anticipated. I can't comment specifically on Australia.
Fair enough. Fair enough. Perhaps if you can't comment on Australia, can you give me maybe perhaps a case study or an example of how you engaged with a company overseas, and how and what was the result of that?
We communicate with sort of many, if not most, of the companies we're investing in, and that's broad communication, really, to understand the economics of their business longer term, and our focus around ESG factors is in respect of understanding that, and we've invested in businesses like Sunrun in the US, a solar residential installation business that has a controlling shareholder who was chairman and CEO and very well remunerated given the size of the business. And there were questions around the suitability of that for a listed company at the life stage that he was at, and, or the company was at. So, we have those kind of conversations with them. I don't anticipate that by ourselves we're going to see significant changes, but the important thing from our perspective, is to have good relationships with those kind of people to help further our understandings of the businesses and the industries. And when those conversations are at a high level, you have some ability to convey our thinking and the thinking of investors generally back to them. And I think it does have some influence over time.
Thanks, Tom. Here's an interesting question here for you, Lachlan. I'm going to paraphrase the question, but I think what the person is asking is, how do you get confidence, or how do you build confidence on the long-term growth rate that you use in your expectations?
Yeah, absolutely. It's a good question. A lot of the companies we're invested in, the ones that have structural growth drivers, for Google and Facebook, you can look at the total advertising market and you can make an assessment about what percentage you think the digital company is going to take from traditional media, and that kind of instructs your view. So you always want to bring it back to looking at the total market and then working out sort of a percentage you think they can take of that, just so you don't have any crazy growth rates in your valuation. So for us, we get a lot of comfort from looking at that aspect, but also we try and break down like revenue growth in a number of ways, and we'll think of as many ways as we can to kind of form up the view that this is the right growth rate to apply, because you apply a high growth rate for too long, and your valuation is going to be way off. So that's how we do it, Nathan.
Fair enough. Look, I'm looking at the questions here. I think we've exhausted everything from the audience. Before I pass it back to Toby for sort of closing remarks, maybe what I can do here for everyone is just touch on sort of the key things that I've heard from you guys today. First of all, just in regards to the U.S. elections, what struck me, the key comment there was, you can't know the unknowable, and you shouldn't really try to structure a portfolio around unknown things. Around China, clearly there was a split decision there between Lachlan and Mark. Time will tell who's right, but I think Tom brought in an interesting perspective that, given the environmental problems that they have over there, sustainability is definitely something that's front of mind if you're a Chinese investor. Around ESG, the view there is that we're moving away from that sort of traditional backwards looking, perhaps focusing on risks, to really focusing on outcomes. What are the long-term consequences of what the business is doing? And Lachlan, you brought up a good point there as well around monopolies. Do you really want to hurt your national champions when going into a hyper-competitive world? And lastly, just around methods, what I'm hearing from you guys, it's all really about quality and being very selective. I think one key takeaway I heard from you was that it's not the value today that you're focusing on, but the value that each of these businesses will create in the fullness of time. It's that direction of travel. And also, I completely agree that debt is not your friend, especially when you're trying to have a sustainable business. So look, I really appreciate those thoughts today. A lot for us to take away. And with that, I'm going to pass it back over to Toby to wrap it up.
Nathan, thank you very much for your efforts today and in the previous 2 days. And Mark, Tom, and Lachlan, thank you for your contributions. And the one thing which really came out for me from this discussion, perhaps unsurprisingly, but is the real commitment to active management as the only way of sustainably deriving the sorts of returns that investors have grown used to and are going to require. It's ironic. It's a view I happen to subscribe to myself as well, and it's ironic that the recently released government policy on superannuation, the setting standards for performance before you're led away to the chopping block, is most likely to drive an extremely benchmark-aware approach to investment management. So from our three presenters here today, if their view is right, and as I say, I think it almost certainly is, and Nathan, I know this is a view which Morgan Stanley shares, then active management delivered through advice intermediation is almost certainly going to be the only way in which typical investors will be enabled to meet their personal goals. So thank you very much for your time today. Just a quick note on our next webinar series at the end of next month. For almost all advisors, retirement is either an immediate goal for clients, or it's the primary long-term goal for accumulators. In a zero-rate environment, what does that mean for advised portfolios? If the intent of defensive assets in portfolios are income, capital stability, diversification from growth assets, how do you manage that when the expected returns from that part of the portfolio are so questionable? So we'll be joined by Michael Karagianis from Jana to lead us in a discussion, firstly focusing on what are those goals and how realistic are they? What should they be? Secondly, we'll be looking at, in the second webinar, we'll be looking at traditional fixed interest investment classes. And in the third webinar, we'll be looking at meeting those goals using other strategies. Does this mean that equity for income, or the income, the total returns from equity portfolios will be the dominant theme in portfolios which otherwise would have been more fixed interest oriented? So please join us for that series. We look forward to having you with us. Thank you for your attendance today. Nathan, Lachlan, Tom, Mark, thank you for today. And we'll look forward to you joining us all again. Thanks.